Hi everybody, let's now go through extract 2. Bear in mind everything on the right hand side again. All the potential questions, likely questions to come up from extract 2 have been covered in other videos which you can check out. Remember the 10 marker is very likely from extract 2 this year. All theory, you can see in blue here, has been covered in previous videos of mine. All the links to those videos are in the description box down below, so click on those to get all the theory that you need. Your job going through the extract, remember you've gone through this God knows how many times in class with your teacher, you know the extract pretty well. So your job going through it for revision is to focus on what's in the head of the examiner. When the examiner was writing this extract, why have they written it in this way? What are they signalling? That's your job, and I'm going to help you with that in this video. And lastly, your job, remember, is to understand everything to do with the extract. Every little key term, every little bit of economic theory, every topic area you need to make sure that you understand so that you can score regardless of what question comes up in your exam. Remember, I have a big guide, brilliant guide of model answers given the likely questions that are going to come up this year. The links to get that guide is in the description down below. Make sure you do. It's a definite way to ace your exam this summer. I'd hugely recommend you getting it. Spend a lot of time putting that together just for you and your benefit. So do get that guide, and that'll make sure you can smash the questions related to extract 2. Let's go through extract 2 then, and as we go through you'll see why I've picked out these key things that you need to know as we go through it. Look at the title, Globalization and Balance of Payments Imbalances. We already know globalization from extract 1, but now the focus is not on trade but on balance of payments imbalances. Okay, so imbalances in this balance of payments. That takes us straight to this first bit of theory that you need to know. You need to understand the balance of payments in detail. While globalization has brought about an increase in the volume of world trade, that's what we looked at in the previous extract, it's also increased balance of payments imbalances. Right, the extract then moves on to talking about current account imbalances, specifically that of China and that of the USA. So if a current account is imbalanced, basically it doesn't sum to zero. It's either in significant surplus or in significant deficit. So this chart is telling you the extent of the current account surplus in China measured in billions of dollars, billions of US dollars, and the extent of the USA current account deficit. That's all it's showing, and it's saying that China recorded a very strong current account surplus, around $200 billion in 2013, whereas the USA are recording a significant current account deficit of around $400 billion in 2013. You can see that the Chinese surplus has reduced in this period, and the US deficit has also reduced in this period. That is a sign of the economic crisis having its impact and generally reducing the volume of world trade. Therefore, the size of surpluses and deficits are going to reduce. That's not surprising. You can see how the trends are very similar. That's interesting, and that's very interesting. But at this point, it's worth now considering what you need to know with respect to the balance of payments. You need to know the structure, the different accounts of the balance of payments. You need to know, specifically focusing on the current account, what can cause a current account deficit or surplus. What are the consequences of the country having a deficit or surplus? So watch my theory video to make sure you really understand that. And now the next bit. Look at this next paragraph. I think it's a clear signal here. The period between 2007 and 2013 saw fluctuations in the current account deficit of the USA and in its effective exchange rate index, which is what the next chart shows. But look at this next sentence. Changes in its effective exchange rate, this is for the USA, did not always have the expected impact on the USA's current account deficit. Well, at this stage, quickly, let's go to the chart on the next page. You can see the effective exchange rate index. What it is explained at the bottom of the first page of extract 2. And basically, what is the trend showing? The trend is showing that since 2007, the US dollar has depreciated. That's the general trend. Slight swings, but general depreciation. If we focus on one period of time, so between 2009 and 2011, you can see that the US dollar had depreciated quite significantly actually in percentage terms there. But if we look at the USA current account deficit between 2009 and 2011, you can see that there wasn't a drastic improvement in the USA current account deficit. In fact, the deficit got worse in that period of time. And that's what the last line of the first page is getting at. changes in the USA's effective exchange rate index did not always have the expected impact on the USA's current account deficit. Now, we expect that an exchange rate fall should, in theory, improve a nation's current account deficit, right? It should take it towards zero, maybe into a surplus. But in the USA, it got worse. That, for me, is a signal as to what your question will be. So, watch my potential question video from Extract 2 to see the 10 marker that I expect to come up significantly related to that. And that takes us on to this next bit of theory you need to know. Exchange rates in detail, right? Like I said, as soon as exchange rate is mentioned, you need to know everything. Whether it's in the extract or not, you need to learn everything around that theory. So you need to know the difference between a floating and a fixed exchange rate. You need to know why an exchange rate can go up and down, so the causes of exchange rate movements. You need to know the consequences. This is very important. This is what your question is going to focus on in the exam. Consequences of exchange rate changes, specifically of exchange rate falls, and what that should do to a current account position for an economy, but evaluation alongside that analysis. And your evaluation must focus on the Marshall-Lerner condition and the J-curve effect, as well as some of the other key evaluation points too. So I've got videos relating to all theory there for you guys. The last paragraph is important as well for you to focus on, to remember that the current account is not the only account in the balance of payments. Balance of payments imbalances can occur in other accounts on the balance of payments too, i.e. the financial account, which is what this next paragraph focuses on. So it says, look, that global imbalances have not just focused on the current account, not just impacted on the current account. It then talks about how savings from poor countries have flooded into the USA. A question might be, why? These flows from developing countries to the USA have helped fund consumer spending, i.e. have helped fund US import expenditure, and they have provided an outlet for excess savings in developing economies where financial markets are not always developed, i.e. banks don't always exist in developing countries, they're not trustworthy, maybe they're underdeveloped. So it's very difficult for individuals in developing nations to save that money, hence the US is an outlet for them and a lucrative rate of return for them. These financial flows, international financial flows, are recorded on the financial account of the balance of payments of individual economies. And you should understand that what does that mean? It means that for the USA, who's seeing a huge amount of debt and portfolio investment coming into their country, that's going to lead to a massive financial account surplus for the USA. Yet for developing countries like China and others, a lot of this money is leaving their country, outward debt and portfolio investment, which means they're going to be recording a very large financial account deficit. Hence, the balance of payments imbalances relating to the financial account there. Okay, that's what this paragraph is getting at. And it makes it very clear in the last two sentences. Countries with a current account deficit experience inflows on the financial account, i.e. the USA, whereas countries with a current account surplus experience outflows in the financial account, making that very, very clear. So international finance flows from poor to rich countries, such as the USA. So making it clear how current account imbalances can be financed, or can be serviced. And they are serviced with financial account surpluses in this case. Alright, so imbalances in one account will actually lead to imbalances in another account, making that very clear. So that comes back to you knowing, number one, in detail, the structure of the account, the significance of the different accounts, very clear. Questions from that, I think unlikely, because it's written in such detail for you in that paragraph that again it'll be like a comprehension if questions came related to it. But I've got other videos covering that, so watch those videos. Remember to get my model answer guide. It's so important for you to smash this exam and for you to answer these questions in detail, knowing exactly what you need to do, how you need to do it. If you get that guide and just learn everything in it, you are going to score almost full marks, if not full marks, in your exam. Thanks very much for watching, guys. This is Extract 2. Learn everything in it. Bear this in mind, and I'll see you all in the next video. Thank you.